Point of Non-Viability (PONV) clauses in capital instruments, exploring definitions and impacts on finance. Agenda items: Introduction to PONV clauses, mechanism of PONV clauses, implementation in capital instruments, impact on financial institutions and investors. Point of non-viability. PONV clauses explained. Point of non-viability clauses outline specific actions for non-viable banks to follow, ensuring structured responses to financial crisis. Shareholder and creditor responsibility. The clauses ensure that losses are primarily absorbed by shareholders and creditors, protecting the financial system. Safeguarding public finances. By utilizing PONV clauses, taxpayer funds are preserved, ensuring that public finances remain secure during banking crisis. Point of non-viability and regulatory context. Emergence of PONV clauses. PONV clauses were developed as a response to the vulnerabilities exposed by the 2008 financial crisis, necessitating stronger regulations. Regulatory frameworks. The crisis prompted a reassessment of regulatory frameworks to ensure financial institutions operate with greater resilience and accountability. International regulatory bodies. International bodies like the Basel Committee have introduced guidelines aimed at bolstering the stability of financial institutions globally. Importance in the financial system. Investor confidence. PONV clauses are essential for maintaining investor confidence in financial markets during uncertain times. Financial stability. These clauses promote financial stability by ensuring that capital instruments can absorb potential losses efficiently. Reducing bailouts. By effectively absorbing losses, PONV clauses reduce the likelihood of government bailouts during financial crisis. Mechanism of PONV clauses. PONV clauses overview. PONV clauses are contractual provisions that activate under certain trigger events, impacting financial stability. Trigger events. Specific trigger events like financial deterioration activate PONV clauses, signaling potential risks. Contractual terms. Conditions that define how trigger events impact capital instruments are outlined in contractual terms. Conversion into equity or write-downs. PONV clause activation. The activation of a PONV clause can trigger significant financial restructuring processes within a bank. Debt to equity conversion. Converting debt into equity can strengthen a bank's balance sheet and improve financial stability. Capital instrument write-downs. Write-downs of capital instruments help mitigate losses and can support taxpayer interests during financial distress. Roles of regulatory authorities. Monitoring financial institutions. Regulatory authorities monitor financial institutions to ensure they adhere to legal standards and regulations, promoting stability in the financial system. PONV clause activation. They determine the timing and activation of PONV clauses, which are crucial for managing financial risk and market stability. Ensuring compliance. Their oversight is essential for ensuring compliance with laws and regulations, safeguarding the integrity of the financial system. Types of capital instruments affected. Subordinated debt. Subordinated debt is a class of debt that ranks below other loans and securities in terms of claims on assets. It's vital for understanding capital structures in financial institutions. Contingent convertible bonds. Contingent convertible bonds, COCOs, are hybrid securities that can convert into equity under certain conditions. They are essential in maintaining bank stability. Regulatory capital instruments. Regulatory capital instruments are essential for financial institutions to meet regulatory requirements and ensure stability in the financial system. Integration into contractual terms. Importance of PONV clauses. PONV clauses enhance contractual clarity and ensure enforceability in legal agreements, especially during financial distress. Conditions for activation. Contracts must specify clear conditions under which PONV clauses become active, protecting parties in financial difficulties. Financial distress implications. Understanding the implications of financial distress helps in drafting effective contractual terms involving PONV clauses. Risk mitigation for banks. PONV clauses explained. PONV clauses define loss absorption strategies during financial turmoil, making risk management clearer for banks. Enhancing bank resilience. The implementation of PONV clauses strengthens banks' ability to withstand economic shocks and uncertainties. Contributing to financial stability. By clarifying loss absorption, PONV clauses contribute to the overall stability of the financial sector. Implications for investors. PONV clauses overview. PONV clauses or post-notice of violation clauses can significantly affect investment strategies and decisions. Risk assessment. Investors need to thoroughly analyze the risks associated with PONV clauses to make informed decisions. Impact on capital instruments. Understanding the outcomes of PONV clauses is essential when evaluating various capital instruments. Market perception and investor confidence. Impact on PONV clauses. PONV clauses can significantly influence market perception by providing added safety in financial transactions, reassuring investors. Investor confidence. Increased safety from PONV clauses can enhance investor confidence, leading to greater market participation and investment. Concerns about risk exposure. Despite their benefits, PONV clauses may raise concerns about risk exposure, prompting investors to reassess their strategies. Conclusion. Importance of PONV clauses. PONV clauses play a crucial role in maintaining financial stability during crisis by ensuring protection of public funds. Understanding mechanisms. Stakeholders must understand the mechanisms behind PONV clauses to effectively implement them during financial uncertainties. Navigating complexities. By grasping the implications of PONV clauses, stakeholders are better equipped to navigate the financial landscape's complexities. Thank you.